This morning, the Japanese yen continued its decline against the US dollar, defying logic. Neither the sudden drop in US bond yields nor the hotter than expected inflation data from Tokyo could stop the yen's fall, which plummeted to its lowest level since 1986, reaching 161.155. Let's delve into what triggered this decline and how long the JPY's drop might continue. The market no longer believes in Japan. The second quarter is ending, marking another disappointing period for the yen. Over the past 3 months, the Japanese currency has depreciated by 6 against the dollar and more than 12 since the start of the year, the largest drop among the Ken currencies. A new wave of sell-offs hit the yen in mid-June following the Bank of Japan's meeting, where the regulator failed to meet market expectations by not reducing the volume of government bond purchases and keeping interest rates near zero. Notably, this week, Tokyo ramped up its threats against currency speculators as the yen neared the 160.0 level. Crossing this threshold in late April led to the government's first intervention of the year, followed by another a few days later. The most alarming warning came from Masato Kanda, the Deputy Minister of Finance for International Affairs, who stated that authorities are closely monitoring the situation and are ready to intervene 24/7 if necessary. However, this proved insufficient to cool the speculative frenzy. Traders quickly realized that Japanese authorities were less aggressive this time, avoiding the usual ready to act decisively phrase, which typically signals imminent intervention. Speculation has arisen that Tokyo might refrain from intervening until the release of key US inflation data, which could naturally help the yen strengthen against the dollar. During Friday's Asian trading session, the yen fell to 161.155 per dollar, a level last seen in December 1986. Even hotter than expected consumer price growth data from Tokyo, which are considered a leading indicator of national inflation trends, failed to support the JPY. The data released early in the day showed Tokyo's core inflation rose from 1.9 to 2.1s in June, raising expectations for several small interest rate hikes in Japan in the second half of 2024. Technical analysis of USD-JPY. Technical analysis shows that the upward trend remains intact. The current position of the Relative Strength Index, C, above 50, indicates a sustained buying momentum. The key resistance level for the pair is now the round figure of 162.0. If this level is breached, the next targets for bulls will be the November 1986 high at 164.87 and the April 1986 high at 178.0. In case of a decline, the first support level will be the Tenkan, seen at 159.1, followed by the June 24 low at 158.75. If these levels are broken, the next supports will be the Senkau span around 158.36 and the Kijun Yen at 157.70.